Hi, I'm MJoy Invests. In the last video, we provided detailed analysis on the importance of investing in water companies. Water has been termed the liquid gold of the 21st century, and I'd highly recommend watching the previous video before this one, as we're going to jump straight into the finances of key water companies to assess which ones are the best to invest in. We're going to compare 6 large water companies: American Waterworks, United Utilities, Severn Trent, Essential Utilities, Pentair, and Pennon, whilst also discussing a large ETF that holds over 40 stocks in the water sector. The ETF is called IH2O and holds utility companies across the USA, UK, Switzerland, Japan, France, Brazil, Canada, Italy, and others. The holdings are split across industrials, utilities, materials, and others related to water companies. For example, it could be companies that produce the pipes for plumbing. This is a good benchmark as it owns all the individual companies we will be discussing. However, it charges 0.65%, which doesn't sound like a lot, but it could significantly eat into returns over the years. So is it better to select a few undervalued stocks, or just simply invest in IH2O to get a share of 40 plus companies in the water sector? I'll go through different metrics to analyse each stock, talking about each one and then providing a summary on the companies. Based on the 5-year performance of each company, we can see that Essential Utilities and Pennon Group fall short of the others, but past performance is not usually a good indicator of future performance. So next we will look at the pay to earnings ratio, or P ratio. This is calculated by dividing the price per share by the company's earnings per share. Typically, a lower P ratio indicates better value, as you're effectively paying less for earnings per share. Based on this, it does look like Pennon, Severn Trent, and United Utilities are overpriced, especially when we compare it to our benchmark IH2O, which has a P ratio of around 25. Next, we will look at dividend yield. Pennon currently looks high, but it's due to the stock price falling. But you can see that utility companies in general pay a nice dividend. This is because utility companies have consistent revenues and so have an element of stability to them. At this point, it is still difficult to select potential winners between the companies, so let's look at the price to book ratio. Price to book ratio measures the market value of a company relative to its book value, or to put it into other words, the market value per share relative to the book value per share, where book value is the value according to its books or accounts. Generally, a lower PB ratio means better value for an investor. Again, we can see that Essential Utilities and Pennon are looking quite good here compared to the benchmark IH2O, but I'd be quite hesitant to recommend Pennon here due to that high PE ratio of 141. However, we can see an outlier here being Severn Trent at 7.75. At this point, I would be quite confident in not recommending Severn Trent due to the high P ratio and high PB ratio, which suggests that the stock is overpriced. But still, this does not give a full picture, so let's look at the profit margin of each company. This highlights that Severn Trent and Pennon have low margins, and at this point I'd be really confident to rule out Severn Trent due to the high P ratio, high PB ratio, and low profit margin. Conversely, Essential Utilities looks like a good investment as it has a lower P ratio and PB ratio to other utility companies and a high profit margin. But now let's look more specifically at each company, focusing on the assets versus liabilities. Assets are valuable items that a business owns, including cash and equipment, whereas liabilities can be anything that a company takes responsibility for, such as wages and debt. First, we will look at current assets versus current liabilities. This is important as current liabilities are typically due within 1 year, and if current assets do not cover it, it can cause short-term problems for the company. This reveals that American Waterworks, Severn Trent, and Essential Utilities do not have decent cover for their current liabilities. However, when looking at total assets to total liabilities, you can see that all the companies have got their liabilities covered. But what is striking again is that Severn Trent is just scraping through, so I would definitely avoid Severn Trent as a company. And you can see that Essential Utilities is well covered at 1.52, and Pentair is covered at 1.72. Therefore, when taken together, I wouldn't worry too much about Essential Utilities' low current asset to liability cover, as it can cover this from its total assets quite easily. So what exactly is the verdict? IH2O does offer great diversification, but I cannot get away from the relatively high expense ratio of 0.65%. I'd personally prefer to build my own portfolio, and I'd definitely avoid Severn Trent at the moment. If I were to rank these 6 companies, then I'd put Essential Utilities right at the very top. Second would be Pentair, and joint third would be American Waterworks and United Utilities. However, American Waterworks does scare me as the current assets to liabilities looks low, which indicates short-term problems. I'd probably avoid Pennon too, due to the low profit margin and high PE ratio. So if I were to begin investing in water companies, which I'm currently doing, then I'd definitely buy Essential Utilities and then look at Pentair, American Waterworks, and United Utilities for now. If there are any utility companies that you'd highly recommend, then leave a comment below and I'll look into them. I am going to start doing individual stock analysis videos again, so if you've got any companies that you'd like me to look into, then leave a comment and I'll make sure I do.